Welcome to Worth Live, and thank you all for joining this week's episode of the Next Normal series on the changing dynamics in the venture fund market. Firstly, I hope you and your loved ones are keeping well during what continues to be a challenging time for so many people. I'm Juliet Scott-Croxford, CEO at Worth Media, and I'm thrilled to be joined by our special guest today, Slava Rubin, founder and managing partner of Humbition and founder and CEO of Indiegogo, and Kathleen Entwistle, managing director and private wealth advisor at Morgan Stanley Private Wealth Management. We're also joined by our co-host Jim McCann today, founder and chair at 1-800-Flowers and chair at Worth Media also. Welcome, everyone.
Thank you, Juliet.
Hi, Juliet.
Our intention at Worth is to create conversations that help inspire and inform our community, many of whom are investors, entrepreneurs, and business leaders who want to leave a positive impact on the world and help to create a more inclusive and equal economy and society for the benefit of everyone through the success that they have created. And we call that Worth Beyond Wealth. So we hope you enjoy this session and find it valuable. Forward thinking has really been the essence of this series, The Next Normal, since we launched it last March, where Worth is looking ahead to what the world looks like in this new environment that we're now all living in. The New York Times declared that 2020 was all about the SPACs. So as we move into 2021, between SPACs, rolling funds, and the recent SEC changes for direct listings and expanding equity crowdfunding, the venture capital market is evolving significantly. So we're thrilled to be joined by thought leaders and experts, Slava Rubin, Kathleen Entwistle, and Jim McCann, as we discuss how VC is changing, the importance of investing in mission-driven companies, and what to expect from venture funding in 2021. A few housekeeping rules, which I know you're all familiar with by now. We really do welcome comments and questions from you. This is a conversation, and we're delighted to have you, the community, be part of it. If you change your chat function to all attendees and panelists, you can use that to submit questions and comments, and I'll monitor that as we go, and we'll weave it into the conversation. And we'll also have some time for questions at the end as well. So let's get started. The changing dynamics in the venture fund market. Firstly, a personal check-in, and before we get going, I'd love to hear from you all briefly about your background and particularly experience in this industry. Slava, let's start with you, and a very warm welcome.
Alrighty, thanks for having me. I'm excited for the conversation. So quick background through my whole background: born in Belarus, came over to America, went to Wharton undergrad, was a strategy consultant for 8 years, started Indiegogo, so the term crowdfunding didn't exist. Had been CEO there for over a dozen years, actually just put a CEO in recently as part of that, seeing all those startup companies help to pass the Jobs Act with the Obama administration. And then got into angel investing, had some good results. So as part of that, then moved into starting a fund recently. So started Humbition, which is a $30 million venture fund. We invest into seed and A. And just to stay busy, I also started another company, which is called Vincent, and it's an aggregator for alternative investments. So that's all of my context for this conversation.
Brilliant, thank you. And we will get into the detail of sort of briefly setting the context of the VC market as well and what these different terms mean. Kathy, I'd like to come to you next. Welcome.
Thanks for having me. It's always good to follow an underachiever. So we'll see how, just teasing. So I am a private wealth advisor, managing director at Morgan Stanley. I've been working just, I'd say, for the last 20 years. Prior to that, I was a stay-at-home mom and raising a family and doing a lot of things on the side to keep my brain moving in the right direction. And I work with ultra high net worth clients and help them make good decisions about their money and bring different differentiating things to the table, like some of the things we'll talk about today, such as SPACs, which we'll get into, but also just giving everybody an opportunity to understand that it's important to have a relationship with their money and trying to help, everybody get comfortable with money as just a tool to help them reach their goals and help them find ways to do it through investing and just different thinking.
Thank you. And I think I'm allowed to say this in that just before we went live, Kathy did say that if she could have dinner with anyone and have a 30-minute conversation, it would be with Slava. So we're excited for this conversation. And Jim, welcome and hi. Please introduce yourself and set the scene for us.
Well, my role in life is I get to hang around with smart and interesting people, and that starts with you, Juliet, and Kathy. Getting to do some of these shows with you has been a treat. Getting to know you better and learn how you think and see how well you serve not only your family, your community, but your client base. It's been a treat to get to know you better. And Slava's been a friend for a few years now, quite a few years. And I agree with you, Kathy. I'm going to arm wrestle you for that dinner with Slava. Only I've had the opportunity to do that. And I'll set the stage, Juliet, with this story. It was probably 18, 20 months ago. Slava and I hadn't been in touch in a while, and I reached out and we agreed to get together. He said, "Why don't you come down to my office?" So I go down to Soho to meet Slava at his office, and as I approach the building, there's Slava at the front door. He said, "It's such a beautiful day." He said, "Why don't we do a walk-around meeting?" I said, "Perfect." So it's even better than the dinner, Kathy, because we got to walk around Soho, only Slava changed the lens in my glasses, because as we walked around, he educated me on some cultural phenomenon that I wasn't tuned into. One I remember, Slava, I remember we walked around the corner and there was this line, went on for a block and then turned and went on for at least another half a block. And it was a pop-up sale. And you told me, well, they're popping up all over, and you explained to me the phenomenon of what's going on here. And these people get word of mouth or social media, and boom, they all show up. And then I remember, I'm a proud grandpa of 6 grandkids, and we walked by, and there was a athletic shoe store, but it was like really, really high-end athletic shoes. And I didn't realize that, but I saw a bejeweled pair of sneakers, as I would call them, being 100 years old. And I said, "Perfect for my granddaughter." And I said to the young lady in the shop, I said, "How much are those?" And she told me $475. I said, "Thanks, but no thanks." And then you whipped out your mobile phone and showed me the community of auction community for athletic footwear and how the collector community worked. So Juliet, Kathy, we have, instead of a dinner, we had a walk around Soho, but he walked me into the shop where they had these 2 enormous security guards, so each of them size of a not so small building, guarding who got in and when. And of course, everybody knows the mayor of Soho, Slava, so we were instantly inside. But that's the kind of guy I like to hang with, and Slava, because he's interested, he's knowledgeable, he's fun, and anytime you spend with him is not only fun, but you come away with checking a whole lot of boxes about things you learned about that day. So I get to do exactly what you said you wanted to do from time to time, Kathy, and that's why I'm so delighted to be with all of you, and in particular Slava today.
Thank you for that story.
So thank you, Jim. And so Slava, with that introduction, set the scene for us, if you will. And I think it would be good to start with a brief introduction to SPACs and innovations in the venture funding market, because I think for many people, SPACs wasn't something that people were familiar with until last year. And then suddenly there was a huge amount of attention on it. And so what exactly is a SPAC, and how has it changed the way companies do business?
Well, Julia, why don't we force Slava to back it up then? We had that wonderful conversation last week in preparation for today. And Slava, you framed it that there were 4 innovations in fundraising, financing that were going on that you think are having a big impact on the market. You want to take us back to 30,000 foot before you get to the SPAC?
Sure. So, when COVID hit, all of a sudden the market collapsed and everybody was wondering, what's going to happen to commodities, what's going to happen to cash, what's going to happen to currencies, what's going to happen to investments, what's going to happen to alternatives, what's going to happen to everything. And now that we're slowly getting to the other side, obviously slowly, there's still a lot of challenges happening person by person in America and the world. We're seeing the zero interest rate environment. And in the zero interest rate environment, everybody's trying to figure out where to get yield. And alternatives are definitely one of those options. And when it comes to alternatives, you have private companies being one of those main options. And you're seeing in parallel to the macroeconomic situation, you're seeing actual innovations that are happening in the funding opportunities. So it's really an exciting time, literally today, as it relates to investing into private companies, thinking about how to take them public, thinking about investing early into public companies, thinking about the various innovations. So between the SEC and just innovation, I would list, 4 main things, and there's a lot of other things that we can talk about, but the 4 main things are: one, SPACs have really become the norm in 2020. SPACs were not invented in 2020. They've been around for a while. It's a special purpose acquisition company. So the 4 things are SPACs, like we mentioned. And then the second thing is rolling funds. The third is the direct listings, like Juliet mentioned. And the fourth is the changing the equity crowdfunding rules. So is that okay as a macro, setting the stage and then going into each one?
Perfect.
Yeah.
Okay. So the first is SPAC, like we mentioned, the special purpose acquisition company. It's been around for years. As a matter of fact, I told this team probably about 5 years ago, an investor approached me to do a SPAC with Indiegogo. And back then I actually had to research what a SPAC was. I couldn't look at all the CNBC and Wall Street Journal headlines about everybody doing it. But what it is you take a shell company that already exists on the public markets and is no longer relevant, and somebody buys that shell company for the sake of having the online filings and the ticker symbol and being able to already be public. Now, what they do is they have their own money, or they get investors to then invest in what people call SPACs, a blank check company, which you just get a bunch of money and you need to then identify who is the company you're going to quote unquote acquire or merge with, and then put them into the actual shell company. So the ticker could have been ABC, but then you buy some cool company and you turn the ticker in their name. So just recently, I think it was a week or 2 ago, maybe last week, time moves really fast, and it's a perfect counterbalance examples. We just saw SoFi is going to go SPAC. So I don't know how many of you are familiar with SoFi. Anthony Noto, who's absolutely incredible, is the CEO there. And Chamath Palihapitiya is doing another one of his SPACs. I would say he's one of the kings of SPAC. And he's taking SoFi public via SPAC. So the steps there was Chamath had to first go buy the shell company, then either raise the money or use his own money, and then start hunting around for which company does he want to take public via SPAC. So now he's identified that. You could be trading as an investor into that SPAC at any time. And eventually it'll get approved by the SEC and it'll be 100% official. Now his SPAC has already gone up in price because of the announcement of SoFi. So people have more visibility into which the actual company is going to be. There's a small chance that won't actually end up happening, but most likely it will happen that SoFi will go public via SPAC sometime soon. Now, on a counterexample, we just saw yesterday a firm, Max is an investor into Indiegogo, just went public the old-fashioned way. And you can't say it was a problem for him since his stock went up 100%. It's up another 20% today. So, that's part of the IPO playbook. The old school IPO playbook is to see those pops. So that's SPAC. Any questions there, or should we move on?
Slava, I'm sorry, Jim. I was just going to jump in and say too, like as an advisor, I had introduced SPACs to my clients actually in 2019 before it became very popular. And we did a few of those, which are now, we're seeing pops. So one was like CIIG merger is one that we did, and they're buying, a firm in the UK. So that popped, significantly. And the way I always explain to clients is exactly what you said. It's like a blank check, but it's usually someone very significant who has had a stellar career. So they're either, you know, a CEO or a C-suite executive who has, you know, evidence of success in the past, so that it gives people that comfort to reinvest in them, even though we don't know what we're investing in. We know we're investing in them and their ability to find great companies to merge with, run, et cetera. If just wanted to add that little bit, if that's okay.
Yeah, and the concept of kind of investing into quote unquote a blank thing that you're not exactly sure what the investment is has existed before. I mean, that is venture investments. As an LP, rarely are you making the decisions as the LP on each of the venture investments. Often you are writing a blank check to the general managers, to the people who run the fund, saying, listen, here's your blank check. I'd like to have some decent returns, and you know, I believe in you. So it's kind of similar with a SPAC. I believe in who you are, the SPAC manager. I believe that you'll find a great company to invest into in the next year or two. Let's make it happen.
Makes sense.
I think there are a couple of other questions on SPAC, but I think let's go through the other pieces of VC that you outlined, Slava. So rolling funds.
So rolling funds are somewhat more new. Everybody's trying to figure out how to be a VC. Getting into the VC game is very hard because most people don't want to invest into a first-time manager. So it's a chicken and egg problem where everybody wants to have become a first-time manager, but no one wants to invest into a first-time manager. But returns show that first-time managers and first funds or second funds are usually the best returning funds for managers. So it's really a tricky kind of balancing act there. What rolling funds are is where instead of having to, let's call it, raise a $30 million fund or a $100 million fund, where you need significant LPs that will deploy money for years consistently with capital calls. Instead, you do a smaller fund, let's call it a $250,000 fund, where there's only 1 quarter worth of commitment. And if you're happy as the LP with how things are going, you roll. That's where the word comes from. You roll into the next quarter to reinvest again, or take any money left over from the first quarter into the second quarter. So you kind of get to make more decisions. You get to micromanage your VC a little bit more. And in the process, we're creating kind of like the minor leagues of VC. And chances are rolling fund managers today, some of them will become exceptional top money managers in the years and decade to come.
And then direct listings. Explain a little bit about direct listings and also the changes to the SEC regulations and the implications that's had.
Well, direct listings were kind of like a workaround that was against quote unquote the rules. And it has happened a couple times, in the last couple of years. I believe Spotify and others went direct listing. The thing that's interesting is the SEC actually approved it. So before, you were kind of doing something innovative that the SEC is like, are we happy with this? Are we not happy with this? And now they said, you know what, if you want to do direct listing, you want to work less with the bankers and just go straight to, without the underwriting process, you know, take on the risk of not exactly knowing how well it's going to perform, go for it. It's on you, but it's kosher now.
And then the fourth one was crowdfunding, and you got early into that game, but it's evolved significantly, right?
And yeah, in fact, Slava, I believe you were drawn upon by the Obama administration to be involved in the writing of the legislation in the Jobs Act to promote the ability to do crowdfunding, no?
Absolutely right. So this is the one I'm most personally passionate about, and the one I'm most excited about, and probably the one that will take the longest to have an impact, a big impact. But when we first started Indiegogo, we want to actually offer equity into the companies. We didn't want you to have to donate or just buy a product. We wanted you to actually be a shareholder. Because of the rules, that wasn't possible. So we did a workaround, which is now called, crowdfunding, which is, like I mentioned, pre-ordering a product or donating. In 2011, we had a campaign on Indiegogo, which was the crowdfunding campaign to change the crowdfunding laws. That helped to have folks write.
That makes all the sense in the world.
Exactly. And lawyers then wrote a petition, sent it to Congress in 2011. And in 2012, I can't say it's because of the campaign, but it was part of the catalyst. Actually, under the Obama administration, they wrote all of the equity crowdfunding rules as part of the Jobs Act to accelerate money velocity post the 2008 economic crisis and tightening of credit and banks really having a hard time to give out money. As part of that, equity crowdfunding was able to take its first step in 2012. The law passed, but it wasn't until 2016 that it went live in the United States that you can actually do equity crowdfunding, which means as an unaccredited investor, just a normal person, which is a majority, well, like over 95% of Americans are unaccredited investors, to be able to invest in anything and getting public solicitation. So that really changed the game in a small way, where you can invest up to $10,000 of your wealth into an equity crowdfunding campaign, and the company can raise up to $1 million, $1,070,000 to be exact. There are some other rules associated that we don't need to get into details, but now a few years later, 4 years later, they just updated the rules. Instead of $1 million cap, it's now a $5 million cap, which might not seem significant, but the cost of capital really changes because you used to have to, for simplicity's sake, spend 100 grand to raise $1 million. And now you're spending 100 grand to raise 5 million. And $1 million, nothing to sneeze at, but it can't really build that much with $1 million, but 5 million is a lot of money for an early stage company. So I expect equity crowdfunding rules to really become very relevant starting in 2020. Actually, in 2021. In 2020, you actually saw, as part of this rise in alternative investments, huge growth in equity crowdfunding across the entire market. If you want to get into a little bit more minutia, every investor from the unaccredited used to have to be listed one at a time on the cap table as part of the 2016 laws. And that was really annoying because you have a 2,000 investor limit. And that was actually a 500 limit until 2012 when the Jobs Act passed because of Facebook. They called it the Facebook rule because they had so many private investors. But now they allow you to SPV, a special purpose vehicle, another special purpose something, just like a SPAC, special purpose acquisition company. They now let you consolidate it all as one investor. That's actually a really big deal because companies will be more open to getting more investors and it won't be on their cap table. And the last one, which I think will be really big, is being able to what's called test the waters. The previous rules were you were unable to promote your offering before you actually went live with your offering. Now you can actually test in the market exactly like bankers do with IPOs, roadshow it, tell people about it. Would you invest? At what price? How much would you put? All this stuff without actually having to list your offering yet. So you can decide, do I want to list it? Do I not want to list it? At what price? So I think that's going to change the game in 21 for equity crowdfunding.
On equity crowdfunding, do you see it as a vehicle to level the playing field? A lot of what we cover in Women and Worth is obviously the inequities around access to funding and access to capital, and less than 2% of women have access to capital. That number for women of color is even less. With how that's evolving, do you see that driving a more equitable playing field for access to investment and capital?
The short answer is yes. There's a lot of biases, unknown biases that happen as part of the venture world. The venture world is majority white male. Obviously, that's evolving, and it's hard for that diversity to evolve without catalysts. So I think there's plenty of reason for that to evolve, but things like this spark it to be even faster. A perfect example of that is Indiegogo, which was an open platform, is an open platform without having kind of these individual gatekeeper decision makers. About half the money does go to women-led ventures. So it's not because we're looking for half of the things to be women. It's because, it's about how the world is split. And it kind of happens organically on Indiegogo. And I do think these types of rules and more of the opening of the markets will just create a more diverse and more equal to like what the market is normally. Absolutely.
Question on SPAC. First of all, you touched on it a little bit, Slava, but how does it differ from the classic IPO process? And why did we see such a boom in 2020?
I don't know the exact answer as to why 2020 exactly, except for some people who are very influential got into the game and they saw that you can make good money and, take amazing companies public. So with an IPO, you're working with bankers and obviously there's the fees associated with that, but they're underwriting it and it's kind of like on their schedule based on the markets. With a SPAC, you can control your timing and you could do it when you want, how you want it, which is sometimes relevant. Also with an IPO, you don't get the promotional broadcasting of whoever your SPAC partner is. So sometimes your SPAC partner could be a real good bullhorn, like a Chamath, which, you know, is as good as it gets when he's going on to CNBC and he gets 20 minutes to talk about anything he wants, including Anthony Noto and SoFi. That works really well. I mean, they have like the ticker chart of his SPAC, like right to the right of his face, and it's like going up as he speaks. So you can't do that with bankers, with IPOs. Also, kind of the I don't want to use the word old school, but the norm as to how IPOs are set up is they want to price them as high as possible, but the underwriters want to give access to their private wealth clients and the institutions to quote unquote ensure that they have some gains. So the risk for coming in early, you're going to do well. And the SPACs don't have that. So there's this potential to raise at a higher price, which means that the company can get more money. Obviously, the market cap will be equal either way, but where does that first money go? Does it go to the company or does it go to the early investors? And that's where there's this arbitrage / debate as to what's worth it, what's the right move, do I need to control the story, do I want the underwriting knowledge from the bankers in terms of, you know, if it doesn't go well, do I want to float? If it's going really well, do I want to sell some extra shares? So I would say that's where the debate is and the pros and cons. Why 2020 exactly? I do not know the answer to that. If you want my opinions, because
it seems to be a bit of a flywheel, isn't it, Slava? You have the press coverage of this. You have it being, and full disclosure, I'm involved in it a few different ways, but I'll be interested to dive into the conspiracy you just identified of Kathy and her clients getting special inside opportunities in those IPOs. But we'll come back to that later. But it seems like, as you mentioned, Chamath and other articulate, thoughtful, well-respected people who are very involved in this space, saying this is an elegant new model, one of the four that you're shining a light on here in terms of alternative capital raising ideas. And it has some pluses and minuses, a lot of pluses in this case. And it's been legitimized by the press exposure, by the caliber of the people involved, and by how well the companies have traded that have been involved in those, which then begets a whole lot of private companies saying, well, wait, maybe I have another arrow in my quiver here as I look at capital market options, and I can go direct listing, I can do a traditional IPO, or maybe a SPAC gives me a better opportunity to talk to my shareholders, to have some transparency, and to have a better pricing so that there isn't the big swath of upside carved out for all of Kathy's clients. It's just another alternative. But it seems like the flywheel is now there's more and more private companies in private equity portfolios or not who are saying, this is an option I can sell, I can go public, I can do a direct listing, or now let me look at the SPAC option. And so the more SPACs you have, the more clients and companies you see saying, is this an appropriate alternative? And that flywheel is creating this new category.
Yeah, I mean, if I had to guess, and this is just my made up on the spot theory, is before WeWork, imploded and had its challenges, and before we saw SoftBank kind of have some challenges with its vision fund, you really saw private companies staying private longer than ever and continuing to get massive investments from huge investors at the equivalent of publicly traded, but staying private. And what that created was, I think, complexity on what is a good enough company to take public. And probably the bankers, had discussions with various companies saying, oh, I don't know if this will do that well, let's wait, or now is not the right time. You're being compared against this company that's still private, so why are you going public? Now then somebody, I don't know who that is, but somebody was willing to take the risk and say, listen, I'm done with this. I'm just going to go SPAC because I kind of need to go public for one reason or another, or I want to. And then that kind of was the first kind of stone pulled out of the dam. Eventually people were like, you know what, this is a decent concept. Then you get some credible folks like you mentioned, and then it's a flywheel. Now, in my opinion, it's gone a little bit too far. I think there are too many SPACs. I think there's too many blank checks. So I think there's going to be some SPACs that end up having great results. I think quite a few will not have great results. And I think you just have to be very selective.
Do you think, I'm sorry, Juliet, I mean, don't you think too, like with IPOs, the investment banks are the ones, the investment banks are taking on the risk, right, of the company being priced appropriately and that the shares sell through and all that, where on a SPAC, really the individual investors that are, giving their money to the SPAC are taking on more of that risk? Or do you disagree with that?
No, I think that's a perfectly good argument. I think that's the argument. I think everybody will have their opinion on that. I don't think there's a right answer. Let's put it this way. Like, I have massive admiration for Max Levchin, who just went IPO. And we literally saw within 2 days, his stock go up 120%. So I have not called him and asked him, are you frustrated right now? I imagine he's happy because he expected it and he's a smart guy. So there's reasons why he did it, but I think that's exactly right. So I think that's the debate, and it all depends on what you're looking for. Are you looking for certainty on timing? Go with SPAC. Are you looking for potentially the exact highest price? Go with SPAC. Do you want more, support on promotion and, getting the underwriting? Go IPO. Do you want to be able to do the roadshow and get real clarity as to what it's going to look like? As a bottom floor, go with IPO. It's kind of like, it depends on what variables you're trying to optimize for.
Absolutely.
That's a good and interesting analysis. And I like Kathy's question too, because, if I think the standard is a 6% fee to do a standard IPO, because the bank is taking that underwriting risk. Some would argue how much risk there really is. But I think now having another option keeps everybody honest. And I like you, am very fond of and think the world of Max Levchin. And I think last week, as you pointed out, Anthony Noto is a friend, full disclosure. He took us public when he was at Goldman as our analyst over 20 years ago. So, and I've known him all that time, think the world of him, as I do of Chamath. I think last week's SoFi deal was another brick in the wall of legitimacy of the SPAC as an appropriate alternative, because it's going to do well. The SoFi as a company is terrific and will do well. Anthony is so thoughtful, Chamath so thoughtful. So I think it's another one of those credibility moments that you'd circle on the calendar.
And it was really interesting. He exactly answered to CNBC why SPAC. And he said 2 reasons. He said, 1, I wanted guaranteed certainty as to when I would go public. I didn't want to have risk to the window or having decisions based on bankers. And 2, I wanted the promotion of Chamath, and I wanted the media to want to have to pay attention because we're a consumer company that the public needs to know about. So
he and his brand with a value add there, right?
Exactly, yeah. Exactly. So he very much said that was precisely the reason.
But despite that, Slava, you still have a 2-year window, right? It's not a guaranteed timing with
right.
SPAC.
It depends on the terms of the manager. It's often a 1-year or a 2-year.
Right. And for the context, just for context for the audience, of the 200 or so SPACs that went public in 2020, it raised over 70 billion in capital, which is more than the amount of money raised by SPACs in the last decade. So it was a significant outperforming last
resurgence of, like as Slava said, it used to be a popular form that sort of went quiet for a while. I do think that Bill Ackman in the summer,
another milestone.
I think that was when even my clients who had done SPACs the year before, they're like, okay, now I'm starting to see in the press what this actually is. And so it was interesting because I think that took on a life of its own too. And
let's
really
look at it from the other
general
side.
Public interested. Sorry, Jim.
Let's look at it from the other side, Kathy. It's a pretty good investment opportunity for people who buy into SPACs. Separate, the other side of it. So one side is the sponsor puts up the risk capital, creates the vehicle, as Slava has told us, then goes to look for the appropriate merger partner. But as a retail investor, are you telling your clients, hey, you're getting a guaranteed no risk return. and you get some warrant coverage in some of the deals, and you get optionality. You get to take a look. Are you recommending this to your clients as
Well,
some percentage of their assets could be allocated in this direction?
I'm always trying to think of differentiating ideas to bring to my clients. And this was a differentiating idea to be able to bring to them. So I absolutely, like when I spoke to them, there goes my cell phone. Sorry. I have to pick that up. Oh, sorry guys. So what I've done is I've talked to the clients about it, and it's not necessarily, I won't call it like risk-free, but the concept that you can invest in it for a period of time and get your money back if there's no movement, like if there's no purchase, or if you decide, then you have that option. Okay, I'm going to stay in the SPAC or I'm going to take my money back. There is that optionality for it. So I think we have to be careful about saying like risk-free and so forth, but I think it's a great bet when you're betting on somebody who has already proven themselves with a business. And when you see CEOs like, you know, the CEO of Marvel or some C-suite executives from Honeywell or, you know, Bill Ackman or all the different people we're talking about starting to find other opportunities. And we know there's so much cash on the sidelines, right? There's been so much cash sitting around. It's a perfect example that it's ripe. So I think it's a great investment when you have the right parameters set up and you really believe in the leadership of who is leading that SPAC to make that purchase. So generally, yes, but I have to be careful. And most financial firms are very careful. There has to be higher levels of experience and knowledge for clients to be able to participate in SPACs.
I mean, I do think, just to echo the risk, I do think at the end of 21, we'll look back and see that there are quite a few SPACs as they went public, the results were poor. On the flip side, there'll probably be incredible results also, but it's just, you know, which ones are you picking? And
law of larger numbers.
Yeah, exactly.
Juliet?
There's a question from Emily around what the process of shopping for a company to take public looks like. And tied to that, have you seen more of a trend in investment in purpose-driven, mission-driven companies as a result of SPAC? Does it kind of, is there more of a drive to kind of go towards impact-driven companies in this context, or is that not a thing?
I mean, I think those are two separate questions. I'm not a SPAC manager, but if we want to set up a SPAC on this call and I'll raise $100 million, you know, you can send it. I can send you a bank account number.
Get my wallet now.
But so I can't really speak from like actual experience, but I imagine it's similar to being a venture fund manager where I don't know exactly the company I'm going to invest into when I get the LP money, but we have thesis and we have perspective and we have our experiences and we have our networks as to what we're looking for directionally. And after that, you use your networks and you mine the data, you analyze the financials of the markets that you're looking after, and you either hunt down the company or they get connected to you. And it's a function of diligence, figuring out if it's the right metrics and really the chemistry in terms of the leadership. You know, are you all going to get along as people and as significant investors? That's how I imagine how it goes. But again, I'm not a SPAC manager.
Juliet, you and I have seen at Worth, and I think this is, Kathy will have some real experience here. At Worth, we have some sub-communities, and one of them is our families at Worth. And these tend to be families of substantial means. Most of the time, the substantial means has come from a business that someone, either this generation or a prior generation, has founded a business, run it as a family-owned business. And it just seems to us, Juliet and I and the folks around the Worth team, that these SPACs offer a particularly good set of potential solutions to a common set of issues that family-founded, run, influenced businesses have. So, you know, to take a profile, second generation running a business now, third generation's involved, but there's a big third generation. And some aren't involved in all. Some are working in the business. And now there's next generation taking over. So there's succession issues, there's development of successes, there's estate issues, some people say, look, I live on the other side of the country now. I'm not involved in a business. I want some liquidity now. I want all my liquidity. Some say, well, I'd like some liquidity, but I'd like to stay in as an investor in a family business. It seems to us in conversations we've had, which is one of the motivating factors for me to get involved in our SPAC and others, is this is an elegant solution, particularly to family businesses who want that certainty, who want optionality in terms of different factors being treated. Are you seeing this in your portfolio? Particularly, you work with a lot of entrepreneurs and family-run businesses, Kathy. Is that now with its new attractiveness, as Slava has told us, there's now a real legitimacy and a fervor of interest in these? Might this be a solution for folks in your portfolio too, Kathy?
It's definitely a good solution. It has to be for the right clients, and it has to be the right person who is leading the charge. So every SPAC has to be evaluated differently. And I have to say, as Slava said, there's always risks and returns to everything. So, but for me, if it was somebody like you, Jim, who founded 1-800-Flowers, and you have such a reach and such a great business sense, I would say, of course, there's going to be so many people that would want to invest in something that someone we know, trust, respect, has a great, sort of history and track record. That's where we're going to see people want to invest. We're not going to see people want to invest in family-run businesses. There's not the same level of track record or public sort of information available on them. That's my personal opinion. But so I think it could be an option. Maybe it will, sort of hybrid that way. And we don't know where things will go. But for right now, I think it's still, people want the name, the experience, the brand recognition.
And Slava, to Juliet's question about ESG.
I was literally going to go there. Yeah, that's exactly where I was going to go. So
let me ask you this question and take it away. It seems to me, if you're going to consider through whatever vehicle of being a public company, and I would call that the major leagues, the transparency, the governance at all, you better have a thoughtful point of view about your ESG responsibilities and the programs you use to implement them. Is that a legitimate point?
Yeah, I mean, I think that investing in a company that has social impact, or what's called ESG at the kind of public company level, always has benefits, not just because of the impact that you're having on the world, but often it improves margins, it lowers customer acquisition costs, it expands LTVs, it makes it easier to do business. So often doing these things end up really impacting positively on the bottom line. I think you see this in seed stage investments or early stage investments. One of our companies is, as in our venture fund, is a marketplace to end lost. And they're starting with lost dogs. So the idea of being able to reunite lost dogs, obviously there's a positive impact there. It's a for-profit business. They have an economic model. They're monetizing. They're growing rapidly, but it's just doing good in the world as well. More recently, you're seeing Facebook stock going down. What a lot of people are saying is because the ESG money is going to slowly start pulling out because of what's happening. I'm not trying to give you my perspective, but the ESG money as a collective aggregate, that's a lot of money. People want to see impact on the environment. People want to see impact on being able to have more people being underserved, that are underserved with banking. I think SoFi benefits from that. I think the electronic vehicle market, which is on fire right now, is benefiting from all of that ESG money, outside of the potential Robinhood money and the fact that they're riding on Tesla's coattails, et cetera. But I think it's pointing in the right direction. So I think it's just, I think it's always good to do good, but it's also, at the end of the day, if you're doing good the right way, it's just good business.
Yeah, I completely agree with you, Slava. And I would say that, Morgan Stanley, our whole impact area completely aligns with what Slava just said, that our clients are looking to align their values alongside their investments, and it is good business. And we're seeing that more and more.
And I think there are a lot more brands that are actually starting to build themselves with a core purpose in mind that has a broader purpose and impact beyond the bottom line. So I think it's not just sort of, do they have some initiative around ESG, but it's like actually there's increasingly more brands being built with that from the start.
True. I would say true, Juliet, but I think also to Slava's point, and correct me if I'm wrong, but what we're finding is that it actually makes companies money when they make these good decisions around impact investing. So it might be because they really care, or it might be because they really care about ways to continue to make money. I'm not sure, but the idea that they are making those changes and aligning with values of clients will continue to get closer and closer, I think, to that end game where people actually are doing it for many reasons. But right now it shows that you bring the different impact pieces into it, and you are going to get the investment. So that alone, or just like having diverse companies and reflecting the world, you're going to do better because you have different perspectives and different backgrounds and different people sharing insights into what's important to the communities that they come from too.
So I'll bridge both of you. So Indiegogo, I'd like to believe, is doing good and doing well. And from the beginning, we've always had like a passion-driven approach to building Indiegogo. It was very easy to fold up Indiegogo, especially during the economic collapse of 2008 and getting rejected by 93 VCs in a row before we got the most high-profile investors in the world. And it was our passion and it was our desire to do good that had us persevere through all that. And it ended up making our customer acquisition costs lower, made it our recruiting easier. I mean, we well overhired above our pay grade, above our level. And it was because people wanted to be associated with the movement. And what I would bridge the two of you is I think it needs to be authentic. And you might be able to quote unquote fool yourself or fool others for a minute or a quarter or a year, but to actually get those lasting results, it needs to be authentic. And I think everybody will see that and get the benefit of it accordingly.
Great. And Slava, I agree with you too. I apologize, but my point was that it's good to be able to want to do good. And I think that there's so many companies out there that want to do good, but that's not everybody's intention, but they at least recognize that there's value to doing it. And eventually, hopefully, everyone will come around to that.
Absolutely.
Right. That there's a couple of questions.
There's someone else in the room we haven't spoken about yet, and it's this Vincent guy. Juliet was lamenting the fact that Hub millions and millions of dollars are primarily in U.S. equities because you can't get a return elsewhere. So that's why she's over-indexed in equities. But what role alternatives in this space? And heretofore, it was only clients like Kathy's clients who had access to those alternative investments. How are you, small d, democratizing that with Vincent?
Yeah, thanks for asking. That is exactly right, which is 12 years ago, the internet was already pretty interesting. It wasn't obviously the internet we have today, but it was already doing a lot of things. And you couldn't do one alternative investment online, not one. You could only do it through paper. You could only do it analog. You can only do it through the people you know. And now in the last 12 years, you've seen a proliferation of alternative investment platforms focusing on their specific verticals. And what do I mean by alternative investments? I mean non-public equities or bonds. And so, for example, investing into a car as a collectible, investing into real estate, investing into wine, litigation finance, commercial debt.
Athletic shoes.
Exactly. Investing into art, investing into basketball cards, which, by the way, I'm a huge sports cards investor. Well, maybe not the word huge. I very much invest and like to invest into sports cards for decades now. There's things, invest into a horse, invest into farmland, there are dozens and dozens of alternative assets, which obviously the folks on this call know a lot of them, but there's so many that to be able to now aggregate all of it into one place, like Kayak does for airline tickets or SeatGeek does for sports tickets, that's what we're setting out to do with my new company called Vincent. And just aggregating the hundreds of various platforms and the thousands of deals so people can discover and diligence across. Now, the reason for this is I would like to think it's the way that we just talked about. It's to do good, which is the rich have known to create more money, you need to take some risk. But yet the average person hasn't had the opportunity to see all of those options and be exposed to all of that. So we're trying to democratize access to this asset class. I think as economy, we've done a great job of teaching our people that we need to save some cash, maybe have a bank account, maybe have a savings account or checking account, maybe now have a retirement account, maybe have a 401, maybe do a little savings. But I don't think we've done a good job yet of saying, you know what, 1%, 5%, maybe 10, you should actually risk that. You should have some high risk, high return opportunities, because it could be a really great result if you hold on to it for several years. And I think this is the next level of financial empowerment, is getting educated about alternatives. And that's what Vincent is trying to do.
There's a couple of questions I want to get to from the audience. I'm not sure we'll get through to all of them, but Juyong Sin, hi Juyong, she said, does the SPAC retain a percentage of equity post-listing? If so, how much?
Yeah, usually the financial manager is, as part of their compensation, getting to retain a part of the company. I think it varies. I don't have the exact number. Jim, you might have a number.
Well, it starts at 20%, but when you have a competitive marketplace, everything except for the underwriters, 6% is negotiable.
And to be clear, what the 20% is, if they're investing like a $300 million investment as part of the SPAC, they get 20% of the 300 million.
Got you.
In equity.
Yeah.
Right. And then
which usually there's a lockup associated with that, so that they can't sell the next day when it goes public, so that the markets don't tank. So then potential, anyway, we're getting to
And then Susie Burke asks, do you see any reluctance for investors to invest in companies that are PBCs? Do we know what that means?
No.
Susie, maybe you can elaborate on your question. A public benefit corporation.
Oh, I think Etsy is a public benefit corporation. It goes back.
You had a prominent one today that's involved in vaccines that said we're going to go to, so they're for profit, but they intend to distribute their profits for good. So it's I think we'll see more and more of these, especially when you get to these big purpose-driven organizations.
And then Mayhol, thank you for that question, Susie. And then Mayhol asked, have you seen any noticeable adoption when it comes to more diverse company investment structures that reject the traditional 10-year VC fund model, or perhaps embrace a different ownership model such as steward capitalism?
I mean, I think that's the essence of this call. I think venture investing is completely changing. I think you see the rolling funds. I think you see the SPACs. I think you see more than ever, folks are getting access to this early stage investing through equity crowdfunding, just as a doctor or a lawyer sitting at home. I think that's all becoming more democratized. The thing we haven't even touched on yet is blockchain and the impact it's going to have on marketplaces, and how we're going to have future marketplaces that will evolve. Like, we haven't even touched on this concept, which is DeFi, decentralized finance, which is happening on the blockchain, which this is next level PhD stuff, comparatively high risk, high return. But I guess what I'm getting at is, I think the financial markets are massively changing. FinTech is very hot. And it's good, because I think that the older banks and the institutions, want to innovate, and the upstarts are forcing everybody to step up their game. It's good for everybody.
I wonder if any of you see any potential for these changes in the capital investment accumulation infrastructure, potentially helping very small businesses. We've seen the number that about 400,000 small businesses have been damaged significantly, or have had to close as a result of the COVID pandemic. Any of these tools, Indiegogo, I like the idea. It used to be a famous restaurateur, maybe a maitre d' or a chef, would leave a restaurant and go and open up his own place, a half a mile away, and a bunch of his wealthy clients would be angel backers of his restaurant. Is there a way to make that more democratic, Slava, with the tools available?
That's exactly what's happening. I think we're in the early innings. 2016 is where equity crowdfunding started. We just expanded it now in 2020. I think that's exactly what's going to happen. You're seeing the disintermediation of everything. And I think that disintermediation of finance will continue to happen. I do think our future looks like what you're talking about, which is a restaurant is both getting the sales from the food and the investment from their clients in an ongoing, whether it's a monthly subscription, whether it's funding rounds happening through the internet, Whether there's going to be banks or websites like Indiegogo to intermediary that, I don't know, but I think that's where it's headed. It's not going to be able to solve the problems we have today with COVID and all the small businesses that are having challenges. The way I like to say is the things that we expect to happen fast never happen fast enough. And the things that we think are going to take a long time happen way faster than we expect. So
we'll be quoting you on that a lot.
Well, it's not my quote, but maybe that is.
It is now.
Yeah, but
you're the one I heard say it.
If you think of 2016 as the year that equity crowdfunding started, and you just allow it 20 years, I am willing to say guarantee that 2036 small business funding will be massively changed. And 20 years sounds like a long time. It really is not that long. It really is not that long. I mean, back up, Amazon is well over 20 years old now, right? So just to give you perspective, like it happens in a blink, and before you know it, you have the iPhone. You know what I mean? The iPhone's not even 20 years old, right? So like 20 years is not that long.
Well, Juliet, I know we know where Slava will be when there's a World Cup played again. But back to you, to wonderful conversation. I think both of you see why I like Slava so much and why we've stayed connected over the years. He's just a wonderful, engaging, and thoughtful person, and he's at the center of so many things. Now you see, I learn every time I talk to him, right?
Yeah, I agree, and it's a privilege to be on this with all of you. I've educated myself in this process. So Slava, Kathy, and Jim, thank you so much. It's such an interesting and insightful discussion, but the depth of your knowledge is fascinating. And a special thank you to you, Kathy, Kathy Entwistle's private wealth advisor at Morgan Stanley, for being our partner for this series. We were so grateful for your partnership. And most importantly, thanks to all of you that joined us today. We will be sharing the recording of this session through our newsletter on Sunday. Thanks for your great questions. I know we didn't get to them all, so feel free to send us any feedback or reach out to me directly. You can also email us at community@worth.com. Join us next week at the same time, Thursday, Jan 21st at 12 p.m. Eastern Time, where we'll be discussing what the future of sports could look like for women with Cindy Parlow-Clone, president of the US Soccer Foundation Federation. That might be one that you want to join, Slava, an Olympic gold medalist, and Patty Hubbard, co-founder at Brand Forward, and Kathleen Entwistle at Morgan Stanley Private Wealth Management. We'll discuss how women's sports is changing coming off the back of the pandemic and what the governing bodies of sports have planned for 2021. So you can register for this online at worth.com/events. In the meantime, thank you all again. Be kind, stay safe, stay healthy, and enjoy the rest of your week. Thanks all.
Thank you. Thank you, Slava.
Thank
Kathleen.
you.